It's Bob Huebscher, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment management industry and investment advisor profession. I am the founder of Advisor Perspectives and a vice chairman of VettaFi. Today, we will be discussing the evolving role of private equity. We're going to start with a discussion about the state of the global economy, and then we'll talk about the opportunities for investment and how the world of private equity is changing. We're going to explore the need to democratize access to private investments, expand access to private investments in 401ks, and the role advisors will play in providing access to their clients. My guest today is Joe DaGrosa. He is the founder, chairman, and CEO of Axxes Capital. So, Joe, I'm going to have you start off by telling me a little bit about your career path, your background, what led you to found Axxes Capital, and what is Axxes Capital?
Great. Thanks, Bob. I appreciate being with you here today. Thanks so much for having me. So a little bit about my background. While I live in Miami today, I'm a born and bred New Yorker. I grew up in Yonkers, New York, just outside New York City. I wound up going to work in 1986, so call it going on 38 years now, with PaineWebber, which today is part of UBS. But back in 86, I joined PaineWebber in a 2-year training program called the Management Audit and Controls Program. And it took me about a week to realize I was a glorified internal auditor. So I spent the next 2 years in internal audit. It was a great experience. And when I got out, I was very fortunate.
My guest today is Joe DaGrosa. He is the founder, chairman, and CEO of Axxes Capital.
On the senior executives of the firm, and ultimately on some pretty interesting institutional accounts. One of which was a firm called InvestCorp. And in a great case of serendipity, one of the founders of InvestCorp, which was a very prominent leverage buyout firm, back in the day they were called leverage buyout firms, not private equity firms. But Bob Glazer was one of the founders, had left InvestCorp and asked me to join him as his first partner. So it was a great experience for me. At the ripe old age of 32, I left Wall Street, joined Bob, and he had one condition, which is that the firm be based in Miami. And that ultimately led to me moving down to Miami with my family back in 98. And I've been down here ever since. Wound up spending 7 years working with Bob at a firm called Maplewood Partners. And in 2003, I left. Once again, very fortunate. I left with a partner. We wound up buying a whole collection of Burger Kings out of bankruptcy. I led the turnaround. Ultimately, we sold to Blackstone in 2006. In 2008, I partnered with a family office. We bought an insolvent insurance company in Chicago. Our team got that turned around, and we sold it to a big private equity shop in Chicago. Went on to launch a $900 million REIT focused on the single-family home rental market backed by GIC. But I was always intrigued with the idea of putting out a line of products, having my own financial firm, putting out a line of products focused on accredited investors, and that ultimately led to the launch of Axxes Capital.
Well, great. So let's start off by having you give us your view of the global economy. Where do you think things are relative to some of the key questions, like, are we still headed towards a soft landing?
Well, first, in terms of the global economy, I tend to take a long-term view of things, being in the private equity business historically. And one thing I'll tell you is never bet against the U.S. So I'm still a big believer that the best place for one to have, the vast majority of one's assets is here in the United States. We have governing laws and a body of law that protects investors. So when we talk about the global economy, I see us going away from internationalization and globalization to being more of a set of regional trade blocs. Once again, I think about the Western Hemisphere and how the U.S. really, will dominate the Western Hemisphere. I see a big trend, as I'm sure a lot of your listeners have seen, in terms of, onshoring production. And I view that as a big positive for the U.S. I think we exported too many jobs. I think we've exported too many key industries, including the chip business. And I'm excited and encouraged by the fact that a lot of those businesses, particularly strategic businesses, are going to be coming back to the United States.
So, given that theme of deglobalization, what sectors do you see as ripe for investment, particularly given the outlook for interest rates, which seems to be that it's going to be higher for longer than most people think?
Well, as far as interest rates, I'll start there, and then I'll talk about the your first question. Uh, I'm less concerned about interest rates. I think it's a question of when and not if that rates come down. And if they come down in 2 months or 6 months or 9 months, I'm not losing a whole lot of sleep over that because once again, I tend to think in terms of a medium to long term investment outlook. And so I feel pretty good that rates will be moving in our direction, notwithstanding the fact that they may not come down quite as quickly as people would like. As far as the industries, look, I mentioned just in passing the chip industry coming back to the U.S. I'm very bullish on the chip industry. I think that powers our economy, powers the global economy, and that's something we need to control. And I think firms like NVIDIA and Intel are great companies to look at. So I'm very bullish on that sector over the medium to long term. I mean, chips power everything, and it's only going to accelerate from where we are today. Uh, the other area that I think is very interesting is metals, and not a lot of people talk about metals, but I think controlling strategic metals is very important. I think you're going to see some very big opportunities open up because from a strategic and defense point of view, we need to control the supply of strategic metals. So I think that's a sector to take a real hard look at. As we all know, given what's happening in the world, I think we are going to have to spend more money on defense. So the big defense companies look good over the next 5 to 10 years, unfortunately. And I say that unfortunately from the perspective that, like most people, I'd like to see peace in the world. But I also believe in peace through strength, and I think we are going to have to adopt a policy that's going to lead to greater investments in the defense sector. And I think there's going to be a global demand for what the U.S. produces from a defense and military point of view. So I think those are interesting sectors to focus on once again over the next 3 to 5 years.
So, chips, metals, and defense. So, let's go back to Axxes Capital. What is Axxes Capital? And what differentiates what you do and the products you offer from other private equity firms?
Sure. Let's start from a big picture perspective. And I think a lot of your listeners who are in the industry can probably relate to this. I mean, we've got a couple of interesting trends going on. First, people are living longer. There's no question about it. And that's a good thing. There was a cover story in The Economist not very long ago, perhaps 2 or 3 months ago, which talked about the potential for people to live to be 120. Now, that may not happen quickly, but I think what we'll see is for folks in their 30s, 40s, and 50s, if the stars line up and it looks like they are, they're going to live 3 to 5 years longer than the life expectancy tables suggest. And now that's great news. The potential bad news is they may outlive their assets. The average person may outlive their assets. And so I think there's going to be an increasing need, just like a large pension fund does or insurance company, to match assets and liabilities. And I think people are going to need to get a better return on their investments. They're going to have to think long term, and they're going to start thinking about private investments where there's a fundamental trade-off between liquidity or the lack of liquidity for private investments, but the incremental returns they can generate. Now, those incremental returns, and let's just for argument's sake say it's 3%. 3%, compounded over 30 years on a base of a 10% rate will lead to some extraordinary differentials in terms of what the returns would otherwise be with private investments. So, I think that's the place that advisors need to start thinking about for their clients. The other trend that's going on is, this transition of wealth from an older generation to a younger generation. I'm the last of the baby boomers. I was born in '64. But, over the next 10 to 15 years, we're going to see a generational transfer of wealth to a younger generation. And that younger generation, by definition, is generally more risk tolerant. and as I said, need to be more concerned than ever about living longer and matching assets to liabilities. So I think the logical future for investments is to a material allocation of private investments for a large percentage of our population.
Why is it that private investments have traditionally only been available to ultra wealthy families, individuals, and to institutions?
I think for two reasons. One is a market reason, one is a regulatory reason. The market reason is it's been a whole lot easier for traditional deployers of capital, private equity and private credit shops, to source capital from institutions. It's a whole lot easier to go out, hat in hand, and try to raise $250 million from CalPERS than it is to try to go out to, 250,000 investors. So that's point number one. Point number two is from a regulatory perspective. Most of your listeners know we've got the Investment Company Act of 1940. And essentially, what it provides for is a safe harbor provision for private equity and credit shops to raise an unlimited amount of money from an unlimited number of investors, provided that those investors are qualified purchasers. And on the retail side, that's folks with 5 million or more. And so you've got this massive overlooked market of non-QP investors. In our case, we focus on the accredited investor segment, folks with between 1 and 5 million in assets. That's largely overlooked. 15 trillion in AUM among accredited investors in the U.S. Close to 9 million households comprise the accredited investor market, and that's just domestically. Globally, it's about 35 trillion in AUM. They're about 1% invested in private investments as compared to the lower end of the retail qualified purchaser market, call that 5 to 25 million, who are 10% invested. So 10 times more invested in private investments for QPs relative to accredited investors. So it's a huge overlooked market, and there's only one solution. That solution is products need to be registered with the SEC. Provided that you register your products, then you can market to accredited investors. But historically, private equity and credit shops have been very reluctant to go after the retail market. And I think the fact that the likes of Blackstone and Apollo have hit that market hard, and they've demonstrated that there is a massive untapped market and an ever-growing need for private equity opportunities and credit opportunities for the accredited investor market.
So, what is the change that you think needs to happen in the regulatory environment that will democratize access to private investments, make them more accessible to those that fall in the accredited and QP categories?
Well, I think the regulatory regime right now, I think, is pretty good. And I've gone through, what some might say is a painful process of registering products with the SEC. And I'm actually impressed by their approach, which is it is very much to provide protections for investors. And so I actually applaud that, and we welcome that as a firm. Having said that, where I think there's a big opportunity that is hitting some walls from a regulatory perspective is opening up the 401k market to investors. Because as I mentioned earlier, the idea is to match assets and liabilities. And clients have pools of capital. Some are very short term. They've got a, say, 6-month supply of cash at the ready to deal with emergencies. They have a medium term pool of money. Then they have their long-term investments, and their long-term investments are typically locked up in 401k plans. And right now, private investments, for the most part, are inaccessible through 401k plans. And I think that's going to require both the Department of Labor and the SEC to provide greater clarity and greater direction to the marketplace. Because right now, there's some confusing and mixed messages coming out of both those groups. But I think it's in their best interest. I think it's in the best interests of the average American to enable a prudent allocation to private investments in 401k plans. And if we see that happen, I believe that can lead to some wonderful things, not just for investors, but for capital going into this country to drive economic growth. So I think there's a double bonus in enabling 401k plans to access private equity.
And is the essential roadblock the fact that 401ks can't own a private placement or a limited partnership, which is the typical structure for a private investment, or is there some other roadblock that needs to be dealt with?
The primary roadblock is when you have a 401k plan, you have a fiduciary, and then you get to the issue of fiduciary liability. And that is really the roadblock. There is not a clear path to ensure that fiduciaries who approach things in a thoughtful and careful way, that there is still the risk that they get sued if something doesn't go right. And so fiduciaries essentially are the backstop insurance company. If things go well, great. If things don't, the fiduciaries get sued. So no fiduciary in their right mind wants to take on that liability. And so there's been, I'll call it baby steps in the right direction from the Department of Labor, but I think we've got a long way to go.
What should accredited investors consider when they evaluate a private equity opportunity?
Well, I think first and foremost, diversification is important because I don't believe that accredited investors should necessarily be allocating money into a specific direct, private equity deal. So one of the things they should evaluate is how can I get diversification? Who is managing my money at the end of the day? And what we've set up at Axxes Capital, it's got to be a very unique construct. So we create the vehicles, but we are not the managers of those vehicles. We hire, managers who have 20, 30 years of experience, whether it's in private equity or direct lending or opportunistic credit. We hire firms that have incredible pedigrees. And the way we think about it is, Blackstone has, $1 trillion in AUM right now. They certainly don't need us, to deliver retail capital, but there is a whole collection of managers. We call them Goldilocks managers, firms with between 5 and 100 billion in AUM that are phenomenal, top quartile performers in their area of expertise. They've got great teams. They've been around a long time, 20 to 30 years, and they're just not recognized by the market. So what we're doing at Axxes Capital is we have an all-star team that works with a firm called Alborn, and together we identify managers, we underwrite those managers, we put them through a very stringent due diligence process, and then we provide ongoing oversight on those managers. And so we believe we give investors probably one of the highest levels of control that are out there, because you've got Axxes, and we are an RIA and a fiduciary to investors. We're overseeing the managers. Each of our products has, and we're structured with a series of interval funds. Each of our funds has a board, a majority of whom are comprised of independent board members. And then in the background, you have the SEC, and we have to comply with applicable regs. So we provide a very, stringent identification and oversight approach, and we bring some great managers to the market. That's what we want to do.
So talk about the investment product that Axxes Capital offers. Is it essentially a fund to funds? What are the fees? You mentioned it's a interval fund. What are the liquidity constraints? What are the minimums? What other considerations should investors be aware of when they look at your product, your fund?
Our co-investment fund is in the final throes of review and sign off by the SEC. So we're in a quiet period. So I'm going to talk more generally about all our products rather than any specific fund. But all our funds are set up as interval funds. And interval funds fall under, it's a registered investment company under the Investment Company Act of 1940. And an interval fund is an evergreen fund, meaning we take in capital and we redeem capital theoretically in perpetuity. So the way we're structured is we bring in capital initially on a monthly basis, so monthly subscriptions, quarterly redemptions. We provide liquidity every quarter for 5% of the net assets in the fund. And remember, the underlying investments themselves are illiquid. So People talk about providing liquidity, and we do that in a very thoughtful way. But the underlying investments are illiquid, so we can't provide complete liquidity every quarter, but we can provide partial liquidity. And once again, these investments are really earmarked for the long term. Now, in terms of how we structured our products, we have in all cases are structuring in a way that we're trying to avoid the double layer of fees that you typically see in a fund of funds. So how do we make money? We go to a top quartile manager and we say, look, if we were CalPERS, you'd knock your fees in half. So we're actually for you as the manager better than CalPERS because we're not just delivering capital. We are in effect telling the market about you and your firm. So to the extent you decide in the future to launch other products, the market will already know who you are. And I think the big challenge for managers, Bob, is the fact that no one knows who they are on the retail side. And that's what we deliver. We deliver a third party underwriting. When we bring a product and a manager managing that product to market, we do it with conviction, and we can say we've screened a bunch of managers. We believe this manager is the very best. And from the investor's perspective, they're not paying a double layer of fees that they otherwise would pay on a fund of funds. We beat up the managers essentially and split our fees with them. So the investor is paying no more than they otherwise would.
How should advisors think about these new alternative investment products that are coming to market like yours? What should they look out for? What are the key considerations they should be thinking about?
Well, I think a few things. First, I'll address it from the perspective of their clients. Most advisors out there, and I know a lot of them. I'm a former advisor myself. The mindset of a lot of big private equity firms, they think that advisors are somehow unsophisticated, and nothing could be further from the truth. Advisors have a very simple job at the end of the day, but a very critical job, which is to make sure that the asset allocation that they're undertaking on behalf of their clients matches their client's risk reward profile. And so, first and foremost, when we think about an allocation to private investments, whether it's with us or with anyone else, is what is the right asset allocation? So if you're going to, if you have let's say a 90-year-old client, probably not a good idea to invest in privates. If you have a 40-year-old client, who's got a regular stream of income and money earmarked for the long term, that client, you may choose to allocate 15, 20, 25% for the long term into private investments. And then within private investments, no differently than equities or fixed income, you have sub allocations. In equities, it might be large cap, medium, small cap. It might be domestic versus international. It might be growth versus value. You have the same thing in private investments. How much are you going to allocate to the equity portion of private investments? How much to the credit portion? Within each of those broad sleeves, how much in traditional middle market buyouts versus venture capital on the credit side? How much in direct lending versus opportunistic credit versus real estate credit? So what we're trying to do at Axxes Capital is give the advisor the tools, the choices to deliver whatever the allocation the advisor decides. We give a series of products that allow the advisor to decide, okay, this is the percentage in privates, and then within that, here's the percentage we're going to put into each of the following sub sleeves. Each fund is a standalone fund. Minimum investment is $25,000, and we're really empowering the advisor to allocate an appropriate way for their client. And I happen to believe, having been an advisor, that most advisors are thinking carefully and thoughtfully about their clients and have the capability to get those allocations generally correct.
Well, I completely agree with you about the level of sophistication that financial advisors possess and the level of care and the fiduciary responsibility that they have towards their clients. If there's one key takeaway that you'd like to leave with our audience of advisors about how they should think about Axxes Capital and the value proposition you offer to advisors and their clients, what would it be?
It would be the following: that Access Capital has really been built with the advisor in mind. Day one, we decided we are not going to disintermediate the advisor. Rather, our job is to make the advisor heroes to their clients. And everything has been built around that core premise. So that gets to enabling an advisor to serve up products that are top products, that are priced appropriately, where there's not a double layer of fees. Uh, but at the end of the day, it's about performance and making sure the advisor can sleep at night, knowing that the advisor put his or her investors' capital into great products that are going to deliver over the medium and long term. And I think we've done that. We've assembled, I believe, an all-star team, and I'm very proud of the team that we've assembled here at Access Capital.
Wonderful. Well, we'll include some links in the notes that accompany this podcast where you'll be able to learn more about Joe and Axxes Capital. There'll be a link to the Axxes Capital website and a link to connect with Axxes Capital on LinkedIn. Joe, is there anything else you'd like to add?
Bob, I'd just like to thank you. I'd like to thank Advisor Perspectives and VettaFi, and congratulate you on all the wonderful work you do for advisors.
Well, thank you very much. Thank you for listening to the Gaining Perspective podcast with Bob Huebscher, and today featuring Joe DaGrosa of Axxes Capital. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on your favorite podcasting service.